Okay, let's unpack this. Do you see what happened with KIDZ stock on like May 1st, 2025?
Oh, yeah. It just absolutely exploded.
Right. Up by a massive 366% in just one day. And the volume.
Insane trading volume.
Yeah.
It definitely makes you stop and think.
Exactly. You kind of go, okay, what is really going on here? Is this just some, wild flash in the pan?
Or is there something more substantial behind it? That kind of volatility, it definitely screams something big happened.
Could be a game changer, or maybe just pure speculation.
Right.
And that's exactly what we're going to dive into today, specifically for you listening. We want to cut through all that noise, all the hype.
Take a proper deep dive into Classover Holdings, Inc., ticker KIDZ.
Yeah, really get under the hood. We'll look at their actual business, the management team, what they're up to.
The financials, definitely need to look at those.
And this recent strategic shift they've made, which, honestly, seems pretty surprising.
Yeah, we're mostly drawing from the deep dive KIDZ stock analysis report. It's dated May 2nd, 2025, so right after that huge trading day.
Good timing.
And the report really tried to look past that short-term market craziness, assess the actual fundamentals of Classover.
And that's our mission here, too. We want to pull out the key insights about Classover for you.
So by the end, you should have a much clearer picture of what this EdTech company actually does.
And whether there's, more to the story than just a stock price going nuts.
Okay, so let's start with the basics then. What exactly is Classover?
Yeah, what's the core business?
Okay, so Classover, it was founded in 2020. It's an EdTech company, online education.
Right.
Their specific focus is on live, interactive courses for K-12 students globally.
And the interactive part is key, I guess.
Yeah.
Small groups.
Exactly. That's a big selling point for them. Small groups, usually just 1 to 6 students per class.
Okay.
And they make a point of using certified teachers based in the U.S.
So positioning themselves as sort of premium online learning.
Seems like it. Yeah, premium K-12. Focus on that personalized learning experience you get in small groups.
What about their teaching philosophy? They mentioned something specific.
Yeah, they talk about a liberal education approach, which sounds like it's more about engaging activities.
Not just memorizing facts.
Right. English immersion, building skills like creativity, problem solving,
Yeah.
that kind of thing.
Okay, makes sense. How do they actually make money then? Revenue streams?
Well, the main way seems to be subscription fees or, parents paying for unlimited access to these live classes.
A flat fee model.
Yeah, it's like a flat fee. Interestingly, they don't seem to list the price publicly.
Yeah.
The report mentions you have to contact customer support, maybe via WeChat, to get pricing details.
Okay. A bit unusual, maybe.
It is. They also mentioned specialized test prep, so that could be another revenue source.
And I saw something about a physical location.
Yes. That was interesting. They opened their first physical spot, Classover Academy, in Flushing, New York. That was in 2024.
So maybe dipping their toes into a hybrid model. Online and in person.
It hints at it, doesn't it?
Yeah.
But the report emphasizes their main focus is definitely still online for now.
Gotcha. So what kinds of courses are we talking about?
Oh, it's a really wide range.
Yeah.
Their live online enrichment stuff covers, well, English storytelling, math and logic, creative writing.
The core subjects, but also more.
Yeah, public speaking, coding, languages, Mandarin, Spanish, French, even things like chess, Lego classes.
Lego.
Yeah, and various arts, drawing, dance, music,
Yeah.
even yoga for kids.
So a pretty broad curriculum then.
Definitely shows the breadth they're aiming for.
Now, what about this AI platform they're developing? That sounds like a big future play.
It really does. That's currently in development. And a key thing they highlight is this proprietary data set they've built.
The 300,000 hours thing.
Exactly. Over 300,000 hours of what they say are real teacher-student interactions. They plan to use that to train their AI.
For what purpose? Personalized tutoring.
Yeah, personalized, adaptive instruction, real-time feedback. They're targeting a launch in 2026 for that.
That could be a real differentiator if it works well.
Absolutely. And beyond the AI, they talk about having a comprehensive curriculum, tailored for different K-12 ages and levels.
And teachers, they mentioned numbers there too.
Right. They claim over 1,000 certified U.S. teachers in their network.
Okay.
And they also claim a really selective hiring process, like a 3 to 5% acceptance rate.
Sounds impressive if that's accurate.
It does.
So putting it together, where do they actually sit in the market? Are they a big player?
It's a bit mixed, honestly. They call themselves a leader.
Right.
And they did get that hashtag 22 ranking in Time's World's Top EdTech Companies for 2025,
Okay.
which gives them some external validation.
But
The reported revenue for fiscal year 2024 was $3.7 million.
Which in the grand scheme of global K-12 EdTech,
Is pretty small, yeah. Likely a minimal market share right now.
though they plan to hire a lot more teachers.
Yeah, an additional 2,500 U.S. teachers. That shows some serious growth ambition, at least.
Okay, so summing up their main pitch.
It seems to be. Accessible, high-quality, live, online K-12 classes, small groups, certified U.S. teachers.
Personalized instruction, diverse curriculum focusing on enrichment and skills.
Right, plus flexibility for parents and this big future potential with AI integration.
Okay, I think we've got a decent handle on what Classover does. Now, who's running the show? Let's talk management.
Good transition. Yeah, evaluating the leadership team is crucial. Their quality, and importantly, are they looking out for shareholders?
Let's start with the CEO, Hu Luo, or Stephanie Luo.
Right, same person. Hu Luo goes by Stephanie. She founded Classover in 2020, and she's also the chairwoman.
Okay, founder CEO, what's her background?
She has a master's degree, apparently had a previous venture called Dream, but the report says details on that are pretty scarce.
So, not a long track record in public companies.
No, her public company experience is pretty recent, mainly since the SPAC merger in early 2025.
Ah, the SPAC route.
Yeah. What's really significant, though, is her ownership stake. She owns 31.7% of the company.
Wow, okay. So her interests are definitely tied to the company's success.
Absolutely. But it also means a lot of control rests with one person.
What about the CFO?
Yeling Peng. Relatively new, appointed just in April 2025. She's 30 years old.
And her background.
Limited public information available yet, according to the report.
So really, we're judging this team mostly on Classover's performance since 2020.
And how they handle things going forward, especially this big strategic shift we keep mentioning.
Right. Have they faced any major crises before this stock volatility? How did they handle it?
The report didn't find any documented major crises in their short history.
Just navigating the pandemic, presumably, like everyone else in online area?
Probably. So this recent stock surge and the underlying Solana news, that's really their first major public test, you could say.
In terms of communication and managing market reaction, how are they on transparency? Do they communicate well with investors?
Well, they do the standard stuff. Press releases, an investor relations website, the required SEC filings.
Okay.
And they include the usual forward-looking statements.
But
the report suggests their explanations around this whole Solana treasury idea, the why and the what are the risks, might have been a bit thin for some investors.
lacking depth, perhaps?
Could be.
What about ethics? Any red flags there?
Nothing major popped up in the research, obviously for an EdTech company dealing with kids.
Data privacy is huge. COPPA, FERPA?
Absolutely critical. They need to be fully compliant there. The report did note some negative customer reviews, though.
Oh, about what?
Mostly mentioning concerns about teacher quality or customer service.
That could be a reputational risk if it's widespread.
Definitely. And then there's the perception issue around the Solana strategy itself.
You mean people seeing it as too risky or maybe not fitting their education mission?
Exactly. Some might see it as overly speculative, maybe even a distraction from the core business.
So tying it all together, management, honesty, capability, shareholder focus, what's the assessment?
It's nuanced. Honesty-wise, they seem to meet basic disclosure rules.
But the gap between their growth story and the current financials needs watching.
Precisely.
Right.
Capability. Well, they launched the company, attracted users and teachers, did this SPAC merger. That's something.
True.
But executing the AI plan, hitting those big growth numbers, and managing this complex Solana strategy, that's still unproven territory for them.
And shareholder orientation. That's where the Solana strategy really comes in, right?
Yeah, it gets tricky there. The CEO's big stake aligns her interests, sure, but using this $400 million equity facility primarily for a speculative crypto venture.
Instead of maybe reinvesting more heavily in the core EdTech business.
Exactly. It raises serious questions about whether they're prioritizing long-term per-share value for all shareholders.
Feels like it might deviate from focusing on core strengths and rational capital use.
It certainly appears that way from a traditional value perspective.
Which brings us neatly to capital allocation itself. Where are they putting their money?
Okay, so there are definitely investments in the core business.
Yeah.
Developing that AI platform, using their proprietary data. That's key.
Hiring more teachers, you mentioned.
Right. Hiring teachers suggests expected growth. They've also worked on IP, like trademarking Classover.
And the Physical Academy in New York.
And that academy. So those seem like logical investments in strengthening the main EdTech side.
What about M&A? buying other companies.
They've explicitly said they intend to do that,
Yeah.
pursue strategic acquisitions.
Like what kind of companies?
Other EdTech platforms, maybe AI tools to boost their offerings, data sets, even new EdTech ventures.
And they plan to use some of that $400 million facility for this.
Partly, yes. Which, M&A can speed up growth, but it has its own risks.
Integration challenges, overpaying.
Exactly. And remember, they just went through a big merger themselves via the SPAC.
Good point. What about returning cash to shareholders? Buybacks. Dividends.
Nope. No mention of buybacks or dividends. And given their current situation, needing cash for growth.
Highly unlikely anytime soon.
Extremely unlikely.
So how effective does their use of capital seem overall? Return on investment?
Well, return on invested capital, ROIC. It's negative right now, or at least not meaningful because they're not profitable yet.
Right. Something to watch later, maybe?
Definitely. It doesn't tell us much about efficiency just yet.
Okay, let's really zero in on this $400 million equity facility and the Solana strategy. This feels like the elephant in the room.
It absolutely is. It seems to be the main catalyst for all the recent drama.
So the facility itself, it's an agreement with a company called Solana Strategies Holdings, LLC.
That's right. It lets Classover sell up to $400 million of its Class B common stock to this entity.
At Classover's discretion, they decide when and how much.
Yes, at their discretion over a set period. It gives them access to a lot of capital, potentially.
But the big catch is dilution.
Huge potential for dilution. Think of it like slicing the company pie into many, many more pieces. Your slice gets smaller.
Okay. And there's something about registration rights.
Yeah, a related registration rights agreement, or RRA. Basically, Classover has to register those shares so Solana Strategies can eventually sell them on the open market.
And penalties if they don't register them quickly enough?
Potentially, yes. That's common in these types of agreements.
So what exactly do they plan to do with all this potential cash?
Well, the main stated goal is funding a Solana-centric digital asset treasury strategy.
Meaning?
Meaning they plan to buy, hold, and even stake Solana's crypto token, SOL.
Okay. Buying crypto. What else?
Some will go to general working capital, day-to-day operational needs, and those strategic acquisitions we talked about.
And they've hired an advisor for this.
Yes, Chance Securities, LLC, which is part of Mercurity FinTech. They're acting as a digital asset strategic advisor.
And running validator nodes. What's that about?
Yeah, they plan to operate their own Solana validator nodes. It's part of the network's infrastructure. By doing that, they can earn staking rewards.
Not much.
They estimate around 5% to 7% annually, but that's variable, subject to change.
Okay. So what's the company's rationale for doing all this? Why jump into crypto?
Management is framing it as, innovative.
Uh-huh.
They say it enhances balance sheet agility, strengthens their financial position, positions them as a leader in corporate blockchain adoption.
So basically, they think it'll create long-term shareholder value.
That's the claim.
Yeah.
Their advisor even called it setting a new standard.
Sounds ambitious.
Yeah.
Very ambitious. But what are the downsides? The risks must be huge, right?
Oh, absolutely. A cautious investor would see a lot of red flags here.
Like what?
First, the sheer volatility of crypto, especially SOL. Huge potential for capital loss if the price tanks.
Regulatory uncertainty too, I imagine?
Definitely. The rules for companies holding crypto are still being figured out. Could change fast. Operational risks, security risks, managing digital assets, running those nodes. It's complex.
Counterparty risk. What about Solana Strategies Holdings or the advisor?
Good point. Yes. Counterparty risk exists. What if something goes wrong with those firms?
And management focus. Could this distract them from the main EdTech business?
Big potential for distraction, yeah. Diverting time, resources.
But the biggest risk you mentioned is dilution.
Arguably, yes. The near certainty of significant shareholder dilution from that $400 million facility is a major concern.
So overall assessment of their capital allocation strategy.
The investments in the core EdTech business, AI, teachers, IP, they seem rational, assuming they execute well.
M&A has potential, but depends on execution.
Right. But the Solana strategy, funded by highly dilutive means, that looks like a massive departure from prudent capital allocation in their core field.
Seems like a very high-risk use of capital.
Extremely high risk. And the potential for long-term value creation compared to just reinvesting in EdTech seems questionable at best.
You keep stressing dilution. Just how bad could it be?
Potentially very significant. Before this, their market cap was around $125 million, roughly 23 million shares outstanding.
Okay.
If they draw down the full $400 million, That could more than quadruple the number of shares out there.
Quadruple. Wow.
Even drawing down a fraction of it would still mean a big increase in share count.
Which crushes per share metrics like earnings per share.
It severely impacts them. It creates a massive headwind against the stock price actually going up based on fundamentals.
Yeah.
It's a serious overhang for existing shareholders.
Okay, we've covered a ton already, the business, management, these big financial decisions. A lot to digest.
Definitely.
We should probably take a quick pause here. When we come back, we'll dig into how the market's actually reacting to all this news, who owns the company, and really break down the risks Classover is facing.
Sounds good. Lots more to cover.
Stay with us. End of first half. Start of second half. All right, welcome back. We're diving deep into Classover Holdings KIDZ. In the first half, we looked at their EdTech business model, the management team, their financials, and that really surprising move into a Solana treasury strategy.
Yeah, a lot to unpack there.
Definitely. So now let's shift gears and look at how the market is taking all this. What's the vibe, the sentiment around Classover stock right now?
Well, the short answer is overwhelmingly speculative.
No kidding, after that 366% jump.
Exactly. That massive price surge on May 1st, the crazy volume, like over 100 times their average volume.
All triggered by the Solana news.
Right. That's just classic speculative frenzy behavior. Even things like their beta, which usually measures volatility against the market. The reports are conflicting, which itself suggests instability.
So it's attracting momentum traders, people just jumping on the bandwagon.
Looks like it. Traders trying to ride the short-term waves,
Yeah.
Driven by news, not fundamentals.
What about actual users? Parents, students, what's the feedback there?
It seems kind of mixed. The report mentions positive reviews on the company's own site and app stores.
Okay.
But then elsewhere online, like forums, you see some criticisms cropping up. Things about teacher quality, customer service issues.
Okay. So not uniformly positive.
Doesn't seem like it.
Have any Wall Street analysts weighed in? Price targets, ratings?
Interestingly, no. There doesn't appear to be any formal analyst coverage or published price targets for KIDZ, Classover Holdings.
Which is maybe not shocking for a recent microcap stack.
Right, but it does mean there's no real validation from the institutional investment community yet.
Important distinction, too. This isn't the KIDZ ticker on the Canadian exchange, the TSXV.
Correct. Totally separate company. That one does have analyst coverage, but it's not Classover.
Good clarification.
Yeah.
So beyond the huge Solana news impact, what about other recent announcements? Did they move the needle?
Well, the Solana strategy and the $400 facility were obviously the bombshells on May 1st. That clearly polarized people. Speculative buyers piled in, while others worried about dilution and risk.
Understandable. What about before that? Financial results.
Their fiscal year 24 results and those really aggressive 2025 projections they gave, that probably helped sentiment when announced.
Back in April.
Yeah. And even earlier in April, news about their trademark, the AI development plans, their acquisition strategy, that seemed to give the stock a boost too. One report noted an 11–12% jump then.
And things like hiring more teachers, the AI platform updates.
Those earlier announcements likely supported the positive growth story they're trying to tell, but didn't have that same dramatic, immediate stock impact as the crypto news.
Okay. What about the other side of the trade? Short sellers, people betting against the stock.
Yeah, there's definitely short interest. The report cited around 266,000 shares short.
And how hard is it for them to cover their positions?
The days to cover ratio is pretty low, like 1.8 days, but that number jumps around like crazy with the massive volume swings we've seen.
Right.
What's really telling, though, is the cost to borrow the stock. The borrow fee rate.
High.
Exceptionally high. Reportedly over 600% at times.
Wow. That means there's huge demand to short it, and it's super expensive to do so.
Exactly. It shows intense short demand. Plus, there's significant off-exchange short volume reported, confirming active shorting.
Any other signs of short activity? Fails to deliver.
Yeah, there were some instances of fails to deliver noted in April. Sometimes that can be linked to settlement issues or shorting activity.
Options market. Does that tell us anything?
An options chain exists, but the report didn't detail specific sentiment indicators from it.
Okay, so putting all that market sentiment stuff together, what's the big picture?
The big picture is definitely one of a speculative frenzy. You've got extreme price moves, massive volume, totally disconnected from fundamentals.
The crazy high borrow costs for short.
Right. It all points to a market driven by momentum, news reactions, especially crypto news, and probably short squeezes or selling pressure. Not rational valuation of the underlying EdTech business.
Classic speculative microcap behavior, basically.
Pretty much textbook, yeah.
Okay, market thinks it's speculative. Now, Who actually owns this company? Let's look at the ownership structure. Institutions. Insiders.
This is really interesting. Institutional ownership in the common stock is, well, practically non-existent.
Really? Zero.
NASDAQ data was apparently currently not available. Fintel reported 0 institutional owners filed the key 13DG or 13F forms for the common stock.
So no big funds, no pension plans holding the stock?
Not the common stock, no. The report notes some institutions might hold KIDZ warrants, but that's different from the stock itself.
So a major lack of endorsement from professional investors.
That's a fair way to put it.
What about insiders, the people running the company?
Well, we know the CEO, Stephanie Luo, has that huge controlling stake, 31.7%.
Confirmed by filings?
Yes, confirmed by a Schedule 13D filing. High insider ownership can be good, aligns interests.
That also concentrates control.
Exactly. As for the new CFO, Yanling Peng, less info on her holdings. There was a mention of a possible Form 4 filing, but it wasn't clearly corroborated. You'd expect a Form 3 when she was appointed.
Any other insider buying or selling recently?
The report didn't identify any other recent Form 4 filings for the common stock.
So it sounds incredibly concentrated then.
Highly concentrated, yeah.
Yeah.
You've got the CEO with nearly a third of the stock and basically no institutions.
So who holds the rest, the public float?
Likely, mostly retail investors, individual people buying and selling, and potentially Solana Strategies holdings as they start getting shares through that equity facility.
Any estimate on the float size? How many shares are actually tradable?
Estimated somewhere between maybe 15 and 19 million shares.
How does this concentrated ownership affect corporate governance, you think?
Well, having the CEO also be the chairwoman raises standard governance questions about board independence and oversight.
Right.
Plus, Classover is an emerging growth company.
Meaning fewer disclosure rules?
Yeah, reduced governance and disclosure requirements compared to bigger companies.
So the new directors who came in with the SPAC, their independence is pretty important.
Absolutely critical, especially for providing a counterbalance on huge strategic decisions like this Solana move. But we don't have much insight into how effective they are yet.
Okay, so just to quickly recap ownership.
Super concentrated.
Yeah.
CEO holds a controlling stake. Virtually 0 institutional holders of common stock.
Public float, likely retail investors, plus potentially the EPFA counterparty.
And potential governance concerns due to the CEO chair role and emerging growth status.
Got it. Okay, we've looked at the business, management, financials, market mood, ownership. Let's try to synthesize this now and talk about risk. Big picture risks facing Classover.
Yeah, a SWOT analysis is probably a good framework here. Strengths, weaknesses, opportunities, threats.
Okay, let's do it. Strengths first. What advantages do they have?
Well, they're in a growing market, K-12 online EdTech. That's a plus.
The live interactive classes with U.S. teachers.
Definitely a key selling point. And that AI platform they're building, if they pull it off with their data set, that could be a real edge.
Diverse courses, reported user growth.
Right. Getting the trademark was good. And the CEO's high ownership could align interests. Those are the main strengths highlighted.
Okay, weaknesses. Where are they vulnerable?
Top of the list.
Yeah.
They're unprofitable.
Yeah.
And losses are increasing.
Burning cash.
Yeah, negative operating cash flow. Weak balance sheet, low cash, poor current ratio suggests liquidity issues.
Heavy reliance on that potentially dilutive $400 EPFA.
Absolutely. Execution risk is high too. Can they deliver on the AI, the growth targets?
Yeah.
Limited track record as a public company.
Those reported inconsistencies in service teacher quality.
That's a weakness. The concentrated ownership raises governance flags.
Yeah.
And the stock price being driven by speculation, not fundamentals.
Okay. Opportunities. Where could they potentially win?
The overall EdTech market growth is a big tailwind. If that AI platform is truly differentiated, that's a huge opportunity.
M&A could accelerate growth, get them IP or talent.
Right. Maybe expand into related areas, adult learning, more test prep.
And the Solana strategy. High risk, but potential upside if SOL moons.
Theoretically, yes. That's the potential opportunity there. And they could leverage that time ranking for branding.
All right, threats. What are the biggest dangers lurking?
Intense competition is a big one. Lots of players in EdTech.
Execution risk, again, failing to deliver on plans, AI, acquisitions.
Right. Financial viability risk if they can't reach profitability or keep funding operations.
The massive potential dilution from the EPFA hanging over the stock.
Huge threat to per share value. Then there's the crypto risk itself. SOL price collapse, regulatory changes hitting crypto.
Other regulations, data privacy.
Yes, evolving data privacy rules are a constant threat for EdTech. Economic downturn hitting spending on supplemental education.
Teacher retention. Cybersecurity.
Yep, need good teachers. A data breach would be disastrous. Market sentiment turning negative could pop the speculative bubble fast.
What about those 2025 U.S. tariffs mentioned in the report? How do they fit in?
The direct impact seems limited, since they're mostly a digital service with U.S. teachers. Maybe minor cost increases from cloud providers.
So the bigger risk is macroeconomic.
Yeah, if tariffs hurt the economy, reduce consumer spending, that could dampen demand for their services. Might also impact international expansion plans.
But tariffs don't directly hit the Solana strategy.
Not directly, no. Though they could add to general market volatility.
Okay, that's a lot of risks beyond just the SWOT points. Financial viability, execution, crypto, dilution, competition, regulation, reputation. Key personnel reliance too.
Good point. Reliance on the CEO, Stephanie Luo, is likely high. Her departure could be impactful.
Wow. Okay, so we've done a really deep dive here. If we had to boil it down to a brief conclusion.
Synthesizing it all. Classover is an EdTech hopeful in a growing market, but they've made this very bold, very speculative pivot into crypto.
Their financial health is currently weak, lots of losses, relying on external cash.
And they face significant risks, especially that massive potential dilution and all the uncertainties around the Solana venture.
Big disconnect between the crazy stock volatility and the actual business fundamentals.
Definitely seems that way.
So from a pure value investing perspective,
It really doesn't tick the boxes. The crypto strategy makes the long-term business hard to understand and predict. No clear, durable competitive advantage yet.
capital allocation choices seem questionable, especially the crypto part funded by dilution.
Right. Financials are weak. And the price seems completely detached from fundamental value.
So highly speculative, not really a fit for a fundamentally focused investor right now.
That would be the conclusion from that perspective, yeah.
So circling all the way back to the start, that insane stock volatility, it feels like, yes, maybe there's potential for a big reward with this crypto play.
But it comes with exceptionally high risk and uncertainty.
And it really might be overshadowing, maybe even distracting from their actual education business fundamentals.
Could be.
So here's the final thought we want to leave you with. Is this Solana treasury move by Classover a truly disruptive innovation for a young EdTech company? Or is it actually a dangerous distraction? What do you think is the more likely outcome for the long-term value of this business? Something to mull over.
It's definitely a fascinating intersection of EdTech and crypto, a real case study unfolding.
Yeah, absolutely. And if you found this kind of in-depth analysis helpful, if you want more deep dives digging into complex companies and financial situations,
Definitely subscribe to the Stock Analytics AI YouTube channel.
Yep, we're always trying to get past the headlines and understand what's really driving these stories.
Understanding the why behind the numbers is key.
Absolutely. One final quick disclaimer before we go. This deep dive, everything we talked about, it's based on public info available as of May 2nd, 2025.
And while AI was used in the analysis process, the insights and conclusions here are just for informational purposes.
Definitely not financial advice. Please always do your own thorough research before making any investment decisions.
Couldn't agree more.
We really hope you found this deep dive useful. Thanks for tuning in.
Yeah, thanks everyone. We'll catch you on the next one.